Thanks for joining us on Power Lunch. This is Bloomberg Quint. I'm Harsha Subramanian.
Good afternoon. I'm Ira Dugal. Let's get you the headlines. The Nifty and the Sensex trade 0.75% lower, but off the day's lows.
Oil prices jumped the most on record after a strike on Saudi Arabia's largest oil field takes out about 5% of global supply.
The government proposes a 20,000 crore fund for affordable housing and middle-income projects. Promises to contribute half of that amount, the rest to be raised from private players.
Exporters will also get faster tax refunds and more working capital from banks as the government looks to spur the sector.
All right, first let's take a look at how markets are faring. Yatin is here with us. Afternoon.
Afternoon, Ira, and almost a percent kind of cut coming in for the key benchmark indices today. Nifty 50 is down about 95 points as we speak, trading below that 11,000 mark. Of course, the global geopolitical reason is probably why the investors have panicked today. Globally, also, we have seen equities correct in trade after that Saudi oil refinery accident which occurred. Now, if you look at the Nifty 50 advance decline ratio, it's almost one stock advancing to 4 stocks declining. So the market breadth is quite weak. In fact, if you look at the oil marketing companies, they are the top losers right now on the Nifty. We have BPCL down 6.5%, IOC down 2.5%. Along with that, heavyweights like SBI are also down 2.5%. Yes Bank also one of the top losers as far as Nifty 50 is concerned. On the flip side, we have certain consumer names which are doing well. So we have Titan, HUL as well as Sun Pharma. All of these stocks are doing well and being the top gainers on the Nifty. In terms of active securities, do watch out for the entire auto pack. Slightly weak in trade today, led by Maruti, which is down 0.8%. So is the case with Tata Motors, 1.5% down. Apart from that, heavyweights like Reliance Industries as well as HDFC are down anywhere between 1.5% to 2% in trade.
Yatin, thanks for that. A drone attack on Saudi Arabia's oil company, its largest oil field, has sent oil prices surging. One, because it takes out about 5% of global supply. And secondly, there are fears over spillover of geopolitical tensions once again in the Middle East. Bloomberg's Dan Murtaugh joins us from our studios in Singapore. Dan, take us through the latest.
The latest is, as you said, the drone strike happened over the weekend, and we came into this morning's trading. It was probably the most anticipated oil open that people can remember in recent memory, and it didn't disappoint. Prices shot up more than 19% intraday. That's the highest on dollar value that they've ever shot up intraday. They've cooled off a little bit now, but people are waiting what the next step is going to be. How fast can Saudi Arabia get its oil production back up? And what's going to happen next? Is the U.S. or Saudi Arabia going to retaliate? And are there going to be more attacks against Saudi Arabia's oil infrastructure? So there's a lot of uncertainty, and that's, as you said, brought in a lot more risk premium back to the oil market. Where it goes from here, it's going to be touch and go, I think, for the next couple of days. And it's obviously bad news, as you guys were mentioning, for oil refiners who now have to pay more for their feedstock, and they're going to see consumers hurt more even than they already have been by the trade war, as higher prices for diesel and gasoline are going to weigh on demand. So we'll see what happens next.
Dan, thank you for that. Let's also get another external voice. Vandana Hari of Vanda Insights now joins us. Vandana, thank you so much indeed for joining us. This is obviously, taken everyone by surprise. It's been the biggest intraday jump in Brent prices in over 20 years. What's the market pricing in? Is this a knee-jerk reaction, or is this a beginning of a spike in prices in the near term?
Good afternoon, Harsh. So for the time being, the market is pricing in what the market knows so far, which is 5.7 million barrels per day. Nearly 60% of Saudi oil production is out. And it to some extent, it is also pricing in that the assumption that a fire of that scale, explosions of that nature, means the facilities will likely take several days or perhaps weeks to be repaired and for production to return to normal. At the same time, you might ask then, if it is that severe a situation, why aren't we seeing a much higher spike? So at the same time, the market is also factoring in a clear intent on the part of the International Energy Agency, which is the energy policy advisor for the OECD countries, and the U.S. And we heard from the U.S. President earlier this morning that he has authorized the release of strategic petroleum reserves. So right now, that's the twin realities, the knowns that the market is balancing.
Now, even though if the immediate supply squeeze is handled, is the market pricing in for geopolitical risk premium in prices here on if the tensions in the Middle East were to escalate?
That part is a little bit hard to say. We have heard some pretty strong rhetoric from the U.S. president again. I suppose hinting that there could be retaliation once the culprits are identified. But look, to my mind, the tensions between U.S. and Iran, and as a result, the broader tensions in the Middle East that conflict has created, specifically between Saudi Arabia and Iran, I expect them to continue simmering. I said this even a few months ago when we had the tanker attacks in the Strait of Hormuz. I do not expect either the U.S. or Iran or any of their allies in the region to knowingly, willfully walk into a war. That's going to be completely devastating for everyone concerned. So we've seen that before from the U.S. president. We've seen that from the Iranians. There's a lot of rhetoric. They just step back from the brink at the last minute. So there will probably be some amount of geopolitical risk premium in crude prices, but I don't expect this to all spiral downwards into a war in the Middle East.
Vandana Hari, we leave it there. Thank you so much for joining us. Brent, meanwhile, is up nearly 8% as we speak.
Right, oil marketers have a bunch of uncertainties to deal with. On the one hand, there are the external factors like the volatile crude prices and refining margins. On the other, there's the government intervention in setting fuel prices and subsidy payouts. Will the proposal to privatize one of them, BPCL, remove one part of the problem, making the stocks more attractive? Somit Sarkar is joining us with more on that. Somit.
So I'll talk about the concerns that have been impacting the oil marketing companies in the last 1 year or so. Firstly, because of external factors like crude prices and GRMs, there has been some movement and some negative movement in the oil marketing companies. But more importantly, interventions by the promoter, that is the government of India, has impacted the share prices more. Now, these interventions have also led to rising debt amid a high capital expenditure plans of this oil marketing companies. Now, Brent crude has seen some sharp moves in the last 1 year due to changes in the global inventories, demand concerns, trade wars, and because of the recent news that we have heard on the Saudi Aramco refinery attack. Now, from the highs of around $86, it has fallen to nearly $50.5 and is now currently trading at around $65 to $67 per barrel. Now, but as I mentioned earlier, government interventions have been the major overhang on the share prices of the oil marketing companies. And though fuel prices, first let's start with the fuel prices. Now, though fuel prices in India change on a daily basis based on the crude price movement, government last year had asked the oil marketing companies to bear ₹1 impact due to rising crude prices. Now, this had directly impacted their earnings because they had to lower their gross marketing margins. Along with this, during state elections and general elections, we have seen that the oil marketing companies refrain from increasing the fuel prices despite an increasing crude prices. This in turn impacts their earnings. Also, the stake sale that the government has been doing through ETFs has been an overhang on the share prices of these oil marketing companies. Plus, the change in definition in ownership in the recent budget has put in additional pressure on the share prices, as the government can now sell higher stake to meet its divestment target. Now, if we see in the last 2 financial years, the payouts to shareholders by these oil marketing companies has also seen a sudden rise, which could be because the government wanted to meet its divestment target. Now, if in FY18, if you see Indian Oil Corporation, HPCL and BPCL announced a dividend per share of close to 21 to 17 rupees per share, and FY19 for BPCL and HPCL, the dividend per share were nearby to what it was in FY18. Now, for IOCL, it was at lower at around 9.25 rupees, but that was because the company also conducted a buyback of close to 4,435 crore rupees. Now, this rise in payouts coupled with late reimbursement of subsidy amount amid high capital expenditure plans of the oil marketing companies did increase their debt in financial year 2019. Now, though it came down in the first quarter of financial year 2020 as government cleared the subsidy dues, the amount is still high and could rise due to upcoming capital expenditure and the investment commitments that the oil marketing companies have done. So all these factors have weighed on the valuations of the oil marketing companies, and despite the fact that the environment is favorable and earnings are expected to rise in coming quarters due to rising gross marketing margins and a rising gross refining margins, all the three oil marketing companies are trading at a discount to their 5-year average valuation. So this Bloomberg news of government looking to sell its stake to a private company in BPCL could actually boost the valuations of these oil marketing companies, because that would mean no government interventions and no earnings impact for these oil marketing companies. However, if the government sells only a part of its stakes, then the valuation would still remain depressed, because if government is still holding some stake in the company, they could still have some influence over the working of this company. So the key factor that a shareholder needs to keep an eye out for currently is how much stake is the government selling and at what price they are selling this stake to a private company.
Soumya, thank you for that. Air India, meanwhile, has raised 7,000 crore via bonds issued through a special purpose vehicle. Air India Assets Holdings has accepted bids for a 3-year bond issued at a coupon rate of 6.99%. Advaita Palepu is here with some details.
Good morning, Harsha. So bankers close to the issue have told us around 20,830 crores worth of bids were received from investors. This includes banks, insurance companies, primary dealers, foreign portfolio investors as well. So the bond was essentially subscribed by about 3 times. Totally, the government is looking to raise about 22,000 crores for Air India Assets Holding, which is essentially a SPV where some of the non-core assets and non-core operational assets of the national carrier have been housed. It holds around 20,000 of the 60,000 odd crore that the national carrier has. So the pricing of the bond has been cut off at around 6.99, which is, compared to other PSU bonds, is far lower than some of the previous issues. For instance, HUDCO listed a bond earlier this month, and that was priced a little higher, giving the GSEC. And the GSEC today, at this moment, is around 6%. So the bond has been raised at a yield spread of less than 100 basis points as of right now.
Just a brief word, Advaita, this is a GOI serviced bond, which is probably why it attracted so much in terms of investor money. Just explain what that means.
Initially, when the bond was first put out there, that Air India Assets Holding would raise this bond, there was a concern that whether there was a government guarantee, whether the government would backstop the company from defaulting on the bond, or whether the government would service the bond. Essentially, in a government of India's fully serviced bond, the government places the principal and interest payments in an escrow-like facility to pay out investors on a semi-annual basis, as is the structure. So fully serviced bond essentially is a greater security for investors that they will get their money back at the different repayment schedules, compared to a government guarantee where the repayment solely falls on the issuing company to repay. That was a major concern by investors, which is why possibly when the government has since clarified that this is a service bond, the bids have come out much lower than previous PSU bond issues, which have typically had a government guarantee against the payments.
All right, that's the 3-year government bond yield. So essentially, you would want to compare the 6.99 coupon to the 3-year government bond yield. Since it's a GOI service bond, actually there should be very little difference, but it looks like there's a bit more than there would have been. Essentially, it's still a government bond, right? Anyway, let's move on. Real estate-focused NBFC Altico made headlines last week when it defaulted on interest payments to a Middle East-based bank. What has raised eyebrows is the relatively small amount of 20 crore that they needed to pay out. What happened? Well, Bloomberg Quint has exclusive details on the behind-the-scenes action that was playing out that led to this default. Vishnath Nair is here to tell us. Vishnath.
Right, Ira. So, a bit of a long story. So, let's try and get the sense of what exactly happened. So, 20 crore, as you said, a very small amount that was supposed to be paid to Mashreq Bank, which is based out of Dubai. And the idea was that why is it that a fairly large real estate funding NBFC cannot pay this money? What we understand through sources is that Altico had raised about 220 crore from Mashreq Bank, which through the ECB financing route, which was being held as an FD with HDFC Bank here. And HDFC Bank acted as a primary dealer for Altico during this deal. Now, while that money was being held, on the 12th of September was the date when the company was supposed to pay 20 crore to Mashreq Bank, and it was obviously facing that funding crunch. So a few days ago, it reached out to the RBI, and Altico Alteco sought a special permission to use 20 crore from that fixed deposit to pay Mashreq Bank, and the RBI declined, primarily because the rules for end use of financing, end use of funds in the ECB financing route are very strict. So if the funds were raised on lend to real estate developers, then it has to be used for that purpose, cannot be used to pay interest for that amount. So the RBI declined it, which obviously meant that Alteco eventually ended up defaulting on that money to Mashreq. And as soon as the default happened, then on Friday, HDFC Bank essentially took that amount, 220 crore, and adjusted it against the loan that it had lent to Alteco. And this was the primary sort of bone of contention between Alteco and HDFC Bank. According to Alteco, it is not in good faith that this transaction was done, and therefore they are seeking legal advice on what they can do to get HDFC Bank to pay the money back to them. From what we understand from sources is that the bank has claimed that it is in full rights to go ahead and take control of that amount because the company is essentially a defaulter.
Interesting that. Thanks, Vishwanath, for that. Yeah. The government came out with measures to try and spur up two sectors over the weekend. The finance minister announced incentives for affordable housing and exporters. Let's start with real estate. The proposal is to set up a 20,000 crore fund aimed at bailing out stuck projects which have not yet been declared an NPA or taken the NCLT route. The government will contribute 10,000 crore. An equal amount will be raised from private players as well. This fund in turn will be managed by professionals, but private players are not willing to pledge support to the fund just yet, choosing to wait for details before they commit. Let's hear out what K.K. Mistry of HDFC had to say.
My sense is we'll have to wait for the guidelines to come to understand what is meant when the finance minister said non-NPA, because an NPA is a technical thing. If a developer has been unable to pay 3 monthly installments, the loan gets classified as a non-performing loan or an NPA. So if it gets classified as a non-performing loan, then based on what the finance minister said, the funds will not be available from this fund which has got created. Money will not be available from this fund which has got created. But we'll have to understand what definition is being prescribed to the word NPA by the, which I'm sure will get clarified in the rules. It cannot just be a technical NPA. I can understand, as you said, that if a case has gone to NCLT, then let the legal process take over. But just because 3 installments have not got paid because the developer has run short of money, if those kind of cases also will not be eligible for this kind of funding, then we'll be restricting the number of projects that could get covered under the scheme. If as the fund is going to be professionally managed and professionally run, we would probably look at making some contribution. What amount and all is something we need to think through, but we'd be happy to make some contribution.
The other announcement made by the government on Saturday was for exporters, a new tax refund program that will cost the government about 50,000 crore. Nikunj Johri has the details.
Finance Minister Nirmala Sitharaman has announced a slew of measures to boost Indian exports. The Finance Minister has said that the government will provide a higher insurance cover to banks that provide working capital to exporters. This would be done at an additional cost of 1,700 crore rupees, and the government has also announced a new incentive scheme for exporters which will be called remission of duties or taxes on export products, and this will replace the current MEIS or merchandise exports from India scheme from January 1, 2020. The current MEIS scheme would continue till December 31st, 2019. Besides this, the government has also said that the RBI would review the priority sector lending norms for export credit, and this is expected to release about 36,000 crore rupees in export credit.
Thanks, Nikunj, for that. It's been a year since the government announced a 3-way merger between Bank of Baroda, Dena Bank and Vijaya Bank. It was the first of its kind when 3 independently managed state-run banks were merged into one. The 3 have been operating under one management from April this year, but it's got a long way to go before the merger process is actually completed. Vishwanath is here to take stock of how things have progressed.
Hello, Ganesha. So the idea being that these 3 banks, the announcement from the government came in September last year, where the finance minister at that point in time, Arun Jaitley, had said that this merger will ensure that we will create a stronger bank, which will eventually go to better better lending to retail and SME. Now, it has been a year, but remember that in April is when the actual mergers, like in the sense on paper, the balance sheets were merged. Now, the issues are fourfold that are still that the bank is facing. First of which, of course, with respect to the employees. So there, the problem is that first, even before the merger was officially signed, there was an issue of, with respect to making pension provisions, which Dena Bank and Vijaya Bank were going by an older form of mortality rates. So obviously, they had to rework that and make additional provisions. So that obviously added to the cost of the merger. Apart from that, there's also this whole arrangement of, where do these employees go that Dena Bank and Vijaya Bank had once they become Bank of Baroda employees, where do they redeploy them? That process is still underway, is what we understand, and it's been about 6 months since the official merger took place. Apart from that, the next big issue is with respect to IT integration. That is a big one. See, what happens is Bank of Baroda is, while all of them are working on Finacle, Bank of Baroda is working on Finacle 10, while Dena and Vijaya were working on Finacle 7. The idea that Bank of Baroda is pursuing is working with Infosys to create a tool that will help them merge Finacle 7 with Finacle 10 and then make necessary adjustments so that all computer systems work on the same platform. At this point in time, all three are working separately, so all Dena Bank and Vijaya Bank platforms are intact, which essentially also means that they can't do other next level mergers, such as getting all your customers on the same MICR or IFSC code, which will only happen if there is one single CBS that works within the bank. So obviously that cost and that time is also adding to Bank of Baroda's struggles at this point in time. But other than that, of course, there's a bunch of issues with respect to rationalization of branches. What we understand through sources is that they've identified about 500 odd branches and ATMs to be either shut down or merged with existing branches and ATMs. This is only phase one of the whole process. There is going to be another phase, and the number could likely increase to about 1,000. They have about 9,500 odd branches currently in the country with all three banks merged. So that number could come down, is what we understand from our sources.
All right, just cautionary tale for the 4 banks which are going to initiate this process just about now. I think that's all the time we have on the show today. Thanks so much for watching.
Keep watching Bloomberg Quint.